Yeah. Now let's get started with this time value of money. One of the chapters which actually forms the basis of any finance calculation. Till now, the most of the five topics which we have looked at are more stats-driven kind of topics. Whereas this particular topic is the introduction to the world of finance. Any calculation we do, it is based on the time value of money, and all it is saying is the money at different points in time carries different value, right? Probably having 100 rupees today versus having the same 100 rupees after 2 years, the importance is different. Probably if you have it today, probably you can deposit for 2 years for some rate of interest, and you are going to get something more than 100. Whereas if someone is giving me 100 after 2 years, then it is 100 only. Whereas if you have the 100 today, after 2 years, it may be 110 or 115, whatever it is. So that is what is the fundamental behind the time value of money. Any calculation which we are doing in the world of finance, we look at the value associated with respect to time. So whenever we are comparing any two investment options, right? Any two decisions. Probably I have to purchase a bond, or I have to purchase a stock, purchase a share of a company. What should be the investment I have to do? See, in most of the finance calculations, what happens? I invest money today, but the benefits of them come sometime later. So the time is completely different. Across different points in time in future, we get the benefits, but the investment of that happens today. So the timing of your investment, the timing of your benefits, they are all completely different. That's and I cannot equate them on like terms, right? Probably there is if I say I have some 100 crores. I'm investing some 100 crores today, right? I'm investing 100 crores today in some assignment. There are two assignments that are available to me. In one, I'm expecting that I will get 10 crores in the first year, 80 crores in the second year, and 60 crores in the third year. It's a 3-year investment, I'm thinking, where I'm putting 100 crores today, but I'll get money in this order. After the end of first year, I'm expecting that I'll get 10 crores, in second year 80, third year 60. Whereas the second investment, if I put the same 100, probably let's say it is going to give me something like this: 70, 50, 20. Now, what is the key difference? If I look at it on an overall scale, probably it is like saying in the first I am putting 100 crores, but I am getting 150 crores. So 50 crores is my benefit. Whereas in the second, only 40 crores is the benefit. So probably an outright decision may come. Choose the first investment compared to the second, because overall you are getting a 10 crore benefit. But the reality for us is this is coming at different points in time. Probably the 70 which you are getting initially itself, if I redeposit it at some other rate, right? Because I am getting the cash very early, probably I can deposit it again, and by the end of the third year, it can probably, even if I say at 10% I am reinvesting it, I'll get 7 crores every year as an interest out of it. So at least after 2 years, the same 70 will become another 14 crores extra. So the finance calculation always is looked at from the time value of money perspective. I have to give, the earlier I am getting it, the value that it carries is much higher. So because the applications wise, in your bond calculation, you use the same concept. In your stock price calculation, you use the same concept. In your derivatives calculations, you use the same concept. So almost whatever we will be doing as a part of the financial calculations later, this is the base to it, right? The typical basic mathematics is not we apply here, right? The time value is what we have to apply in any investment decision, whether it is projects or purchasing of the bonds or stocks or any financial calculation which we are doing. So from that standpoint, it is very much essential that we understand this chapter, right? And probably from your exam standpoint, it's the usage of the calculator, right? Because this can be done using the system or spreadsheet more and more effectively. But at the same time, the financial calculator, it has specific buttons which will do time value of money calculation. There are a lot of buttons that are present in this financial calculator. This is what I was talking about, the BA2 plus professional version. So what happens is there are some keys here. This row completely this row. They are all finance related calculations. And all these five things we'll discuss in this particular chapter, all these five buttons. And of course, there are a couple of more, right, which we'll see as we move along. Even all these are more and more specific to finance related calculations itself. Using the finance calculator, things becomes more and more easy from an exam standpoint also. So today when we are solving the questions, I'll tell you the mechanism of how do we solve it in this, right? So the same logic, probably if you practice at least on 2 or 3 kind of numericals, it becomes faster. And from an exam standpoint, you should be comfortable with quickly operating it, because you can easily expect at least 5 to 10 questions across all the subjects, 5 to 10 questions which require the usage of the calculator. In probably 1 or 2 in bonds, 1 or 2 in derivatives, 1 or 2 in this quant itself. So there could be at the max there could be some 5 to 6, 5 to 10 questions. So a comfort level in this is very much required. And even at a later point also, in the next levels also, the usage of this does exist. Okay. Now, what are we talking about here? The first thing we are going to look at in this topic is, what do we mean by interest rate? Right? We all talk about I deposit something, I get some return. So generally we talk about the interest rate from 3 dimensions. One, it's a required rate of return. If let's say there are 2 options. One bank is telling me, you deposit the money with us, we'll give you, or take a fixed deposit with us, we'll give you 9% return. Whereas there is another, a local bank, which is promoting you, saying we'll give it at 11% per annum kind of a return. Now, what is the motivation for you to go for a local bank compared to a nationalized or a private sector bank? That extra return which you are giving, because you know that's the risk. Investing or depositing with that kind of a bank probably might create some amount of risk. So the only motivation for you to go for it is you getting a better return, right? So the rate of return changes with risk, how much you are expecting, right? Let's say you have an option of putting the money in a fixed deposit versus putting it in a stock market. Suddenly the same person who is ready to get, who is comfortably getting 8% or 9% in a fixed deposit, the moment he switches to a mutual fund or a stock market, his expectation will be, I have to get 15% per annum kind of a return. Why? Because there is an excess risk that is involved in that. So obviously, the return which you are, so that is what is the definition of the interest rate. One side. What is the return you are going to expect? The required rate of return on any investment. So in some cases, it is specific to person, right? Depending on the risk taking level of the person, the interest rate will change. In some cases, it is more of what is associated with that instrument. The moment you go for a bank fixed deposit, the bank may say 8.5% return. So even your expectation could be 12%, but they say we are giving you only 8.5%. So if you are comfortable only, you will deposit there. Otherwise, you will not. You will try out some other avenue. The second way people define the interest rate is as a discount rate. Discount rate is nothing but this is what is typical application of time value of money. In the future, I'm going to get 1 lakh after 5 years. After 5 years, I will get 1 lakh. What is the equivalent of it today? How much is it worth for today? Right? That is the most common formula which we use as a part of all our investment valuation decisions. Right? Which we even call as net present value. There are so many names that are associated with it, which is nothing but the future values. We discount them at a particular interest rate, assuming at let's say I will get 10% every year. So some money at the rate of 10% every year, it is becoming 1 lakh after 5 years. So what is that some money? How much is required today? So that if it accumulates some interest of 10% over the 5 years, it becomes 1 lakh. That is the rate, which is what is called as a discount rate. So in the context of discount rate also, we use this interest rate itself. The third is the opportunity cost. If I am investing in something, let's say I have invested in buying a house. What is that I am losing out there? I could have deposited the money in a bank and I would have got some return. But by buying a house, I am foregoing that return. That is also my interest rate. Whatever is the amount that I am foregoing because of locking up my funds. All these three definitions of interest rates are used in different contexts. Right at the end, for these three applications, I'm putting some money today. How much I want after 5 years or something, that is my required rate of return. I'll get something after 5 years. How much I should look at it today, even that is my interest rate. Right? If I'm investing here and foregoing some other benefits, what is the worth of the benefit that I am foregoing? Even that is a part of my interest rate itself. And when we talk about the interest rates, we always use the terms like real and nominal. We always talk about two terms in interest rates: real interest rate, nominal interest rate. Whenever the interest rates includes inflation, we call it as nominal. If it excludes inflation, see, let's say the inflation rate in the country is 5%, right? And we say the interest rate is 7%. What it means is the nominal rate is 7%, including inflation, the interest rate is 7%. If I remove inflation, which is what is the real contribution of the interest rate itself, the real interest rate is only 2%. Right? That is the see, because every country has a different inflation. And because of the inflation, you may see, so probably sometimes people keep saying in US the interest rates are much lesser, whereas in India the interest rates are much higher. Again, apply the same logic. That is the nominal rate of interest, which is different in both the countries. If I remove the inflation part from that interest rate in both the countries, the real rate will not be much different at all. Right? The interest rates have a significant portion of the inflation. Whatever is quoted in our newspapers and all regarding the interest rate with the banks and all, it's a nominal rate itself. But real is something, probably you have to keep it at the back of your mind. In all public places, in all public avenues, what is quoted is the nominal itself. But again, within that nominal or real, there is something called risk-free rate. What is this risk-free? Without any risk, I can still get some return. Look at it in a very nominal sense. Let's say I put my money in an FD. Again, in a very crude sense. I put my money in an FD. Government bond, the most better. Not even the government short-term securities. If I put my money in that, there is no way I can lose even a rupee, or probably a bank fixed deposit as a simpler example. There is no way I can lose a rupee on that, but I am still getting some fixed return. That much of return is what we are calling as the risk-free rate of return. But again, within that risk-free also, we have a real as well as nominal. What is quoted even in government securities also is the nominal risk-free return. Even if they say you deposit with us, you will get 4% return. That 4%, 5%, whatever is being mentioned in a government securities also is a nominal itself. So real is always a virtual. Real risk-free rate of return, the word when I am using it, real risk-free rate of return is a virtual kind of a concept itself. Right? This word which we are using, the real risk-free rate, is nothing but whatever is the interest rate that they are giving in case of zero inflation. A country which does not have any inflation, whatever the interest rate I get on a completely risk-free kind of a security. When we use the risk in finance terms, there is no chance of losing. Risk-free is nothing but not even a single chance that I will lose some money. If I put probably in a bank also, if that bank winds up, probably I may lose. There is some chance of losing my money in a bank deposit. Right? Probably as you move along, if you do some kind of credit risk modeling and all, you may see some of the banks, they have some chances of default. That is how the credit ratings and all are typically assigned to the banks, companies, everything. They have small chances of default. But probably when I look at a government securities kind of stuff, the chances of default are much, much lesser or almost nil. Then only we call it as risk-free rate of return. So, for any other corporate, if we are looking at the total return which any kind of a security is giving to me, it has a real risk-free rate, the components that go into it. There is a real risk-free rate. There is some inflation expectation. Real risk-free rate probably is a virtual stuff. Plus, if I am adding expected inflation, it's at least the nominal risk-free rate. The first two things put together is the nominal risk-free rate. But, okay, now default risk premium. If any particular bank or any other particular security, if it is going to default, some chances of default, depending on the probability of default for it, some additional premium will be, some additional return they have to give to compensate that. Right? If you think that there is a 10% chance that I will lose, probably it's better that they compensate that by 2% higher return. So that is what we are calling as a default risk premium. Then liquidity premium. The most common thing is compared to 1 year. Right? Let's say you have an option of depositing your money for 1 year and 2 years. Right? You have two options with you. Take a 1 year FD, take a 2 year FD. What motivates you to go for a 2 year FD compared to a 1 year FD? In general, the 2 year FD should give you slightly higher interest rate compared to a 1 year FD. What is the logic behind that? You are parking your money for a longer time. You are blocking your money for a longer. If both of them give the same interest rate, probably you may think, why not deposit it for 1 year? Again, if I want it, withdraw after 1 year, otherwise redeposit for 1 more year. You can very well think of it like that. But if it is directly giving you slightly higher, it means that, okay, I am very much fine blocking my money for a slightly longer period. Right? So that is what we are calling as liquidity premium. Liquidity is creating a free movement of money versus blocking your money. Right? I'm blocking or locking my money for a longer period. The more I'm parking it for, the more I expect as a return from it. Otherwise, probably I could withdraw it at the end of each year and again decide to invest whether to go for it or not next year if I get the same amount. Right? And maturity risk premium, which is more in terms of, okay, maturity is with respect to the time period, longer period. Liquidity is you being able to withdraw it in the middle versus not withdrawing it in the middle. See, in some mutual funds and all, they say there is a lock-in period of 3 years. Lock-in period of 3 years means in the middle you can't withdraw at all. And if you are withdrawing, there is a big penalty that would be applied for you. Right? So whenever you have all these risks in the plate, the return which you are expecting is always higher than the risk-free rate of return. In a government security, probably you may have only these two. Government short-term security, you may have only real risk-free rate plus inflation. In a long term, what will happen? The maturity risk premium, even though it's a government security, the longer time you are parking, there could be a liquidity premium, there could be a, see, in liquidity, it even comes out like, can you sell off your investment to someone else? Right? In the middle, you want to withdraw. Let's say you have purchased a 2-year FD. In the middle, you want to withdraw. You want to get out of it. In some cases, you can sell that to someone else in the secondary markets. In stock, that is very much possible. I buy some shares of the company. I can sell them off whenever I want. Some bonds, that is still possible. Whereas in some kind of deposits, you may not surrender in the middle at all. That is what we are calling as a liquidity risk associated. If at all you are selling it also, you may have to compromise on the price. Let's say you have your real estate property. Right? You want to sell it off. Right? If in some geographies, probably you can sell it very quick. In some geographies, probably you may not be able to sell them quickly. And if you have to sell it, probably you may have to compromise on the price. That is what we are calling as a liquidity risk there. So even in a government security, if it is a long-term security, apart from risk-free versus expected inflation, you may be exposed to a maturity risk, longer time to park. 2, you may not be able to withdraw in the middle. Because of all these, even a government security long term will have a higher return compared to a short term. If you typically look at, you can even visit the RBI website on a regular basis, which will publish the short term treasury bill rate, government securities rates, and even a long term rates also. So especially in case of short term, it's a reflection of very near future. Whereas long term is over the few number of years. Right? So any risk-free rate of return, any return which we are saying, if a local bank is giving you 11% compared to a nationalized bank, right? The only difference there is the default risk premium is getting added up for them because they have a high chance of default compared to an established or a nationalized kind of a bank. So obviously they have to give this return, otherwise no investor is ready forward to invest. Another example, on one single day in a newspaper, there were ads relating to 2 different gold loan companies which have launched the bonds into the market, which have floated their bonds into the market. 2 big names. And there was another government company, or probably L&T, I don't remember, one of them, which has floated its bonds into the market. This gold loan companies bonds, they were issuing at around 12 to 12.5% per annum. Whereas that government or L&T kind of one is issuing it at around 10 to 10.5% per annum. Now, by default, people get attracted saying, this gold loan companies are giving me 12.5% return, so probably I should go for it. Why are they giving that 12.5% return? First of all, their risk is very high there. And probably that is where I have to check out for the credit ratings of that. Their financials one, two, credit rating is published by every bond issue that comes into the newspapers and market. We'll see the credit ratings associated with that. Even if you look at their prospectus, you'll see the credit rating. This government one is having a credit rating of AAA kind of a rating, which is like a high standard rating. We'll look at that. It is having a highest standard rating, whereas that is having only a single A rating or something. There is a difference in the credit ratings between these two, which means the credit rating company felt that there is some chance of default for this company. Again, it's not that they will default, but the probability of default is higher for this company compared to this company. So the only motivation for someone to go ahead and invest there is they have to be prepared for that extra risk. If we lose, we may lose. Only prepared for that, I'll have to go and invest in that bonds. Right? That is coming because of this excess default risk premium kind of stuff. Now, when we talk about the interest rates, some of the important things that we also talk about in the questions from a question standpoint is, we always get what is called as a stated interest rates. Even the banks, wherever we see stated, or sometimes we call as quoted. It is primarily like it's a nominal rate which includes inflation, but that is what is being quoted. So even if you want to deposit, let's say the better example is, the bank say if you deposit your money for less than 45 days, the interest rate is 5% or 4%, whatever. Now what does that mean? Is that 4% for 1 year, or is that 4% for 45 days? The 4% number is a 1 year rate. Based on that 1 year rate, they will calculate your interest for that 45 days. So whatever the quoted rate is always the annual rate itself. Even if they say you deposit for 2 to 5 years, the interest rate is 9.2%. That is, per year interest rate is 9.2. It's not for that whole of 2 to 5 year period. So the quoted rate is always an annual rate without any kind of compounding or anything associated with it. So most of the questions also, if they say the quoted interest rate is 9.2, right? Or sometimes they may say the semi-annual interest rate of a bank, the semi-annual rate is 8%. Right? The stated rate is 8% compounded semi-annually. It means it's not the semi-annual interest rate is 8%. Annual interest rate is 8%. So for semi-annual, probably it will be 4%. So anything that is given in the question is always a kind of a stated, which is an annual and does not do any kind of compounding. And that stated rate or quoted rate, you will always convert it into a periodic rate, especially if you are getting questions relating to compounding more frequently. If the compounding is happening more and more frequently, like quarterly compounding, semi-annual compounding kind of stuff, if it is there, then we compute the periodic rate out of the stated rate, which is nothing but you divide it by the number of periods. Let's say if the stated rate is 8% and it is quarterly compounded, so my periodic rate will become 2%. Per quarter, 8% by 4, my periodic rate will become 2%. And that is what we'll use for effective rate. Right? One numerical, if I take, it becomes more clear for you. Then we also use what is called as an annual percentage rate, which is nothing but if the periodic rate is 2%, quarterly rate is 2%, and there are 4 quarters in a year, annual rate is 8%. Here no compounding is used in annual periodic rate computation. No compounding is used. It's a simple multiplication. Number of periods multiplied by the periodic rate, which is nothing but it will be equal to your stated rate only always. It will be equal to your stated rate. But given your periodic rate and you are asked for number of periods and you are given number of periods, then you are multiplying the two to get your annual period. That's where it does not change with the compounding frequency, whether you are doing a semi-annual or annual or quarterly, any kind of compounding, your annual periodic, annual percentage rate does not change. But what changes is this effective annual rate. What we do in this effective annual rate, if the stated rate, better example, let's say I'm talking about a stated rate of 8%. Right? Bank is quoting, a better example I'll tell you. You go to any FD, you take any FD or any deposit you have done with the bank. They say, let's say they have said an interest rate of 9%. They quote it in your FD papers and all. They quote the interest rate is 8.75%, 9%, whatever it is. Just check out your final output amount, what you are depositing, let's say 1000. After 1 year, how much you are getting? You find out whether you are getting exactly 8.75 or more than 8.75 or less than 8.75. Right? I mean, simple example I am telling. Let's assume for simplicity 10% is the quoted rate. Right? 1000 you are depositing now. At the end of 1 year, how much you should get? 1100. Straightforward calculation. But when you check out, you will get more than 1100. You will not get 1100. You will get more than 1100. Though they mention it as 10%, very clearly they mention in the quoted rate at 10%. But what you get is more than 10%. Why? That is the quoted rate. But the compounding happens more frequently than the quoted rate. That quoted rate is assuming it's an annual rate of compounding. But in most of the banks, the compounding happens on a quarterly basis. If the compounding is happening on a quarterly basis, obviously what you are getting is much more than 10. That is what we are calling as an effective annual rate. So how do I look at that effective annual rate? You do this kind of a process, which is nothing but 1 plus stated annual rate is 10%. And let's say if the compounding is happening quarterly, there are 4 quarters in a year, which means periodic rate is 2.5%. Periodic rate is 2.5%. And because the compounding is happening every time, you take it to the power of number of periods. Because let's say, what do you mean by quarterly compounding? 2.5% interest is applied at the end of first quarter. On whatever the total amount that is there, 1000 plus probably another 25, which is 2.5%. On 1025, there is a 2.5% that would be applied for the next quarter. That is what we are calling as the compounding. So, what it typically becomes is something like this. So, if I look at it in the spreadsheet, this actually becomes 1 plus 10% by 4 to the power 4. And probably I subtract 1 from this. I'll get it as 10.38%. So, if you look at your actual money which you are getting on 1000 rupees, you will not get 100 extra, you will get 103.8 extra because of the quarterly compounding that is happening in the process. And depending on if they are doing a monthly compounding or even more lesser, your actual value will increase. So if they are doing an annual compounding, you will get only 1100. But if they do a quarterly compounding, you will get 1103.8. And if they are doing different levels of compounding, you will get different amounts. So the effective annual rate is nothing but that particular rate which is equivalent to the stated rate of interest with this much of compounding frequency. So in effect, you are getting 10.38% return. You are not getting 10% return. The 10% is from a bank quotation standpoint, but in reality, you are getting 10.38% return. So why should you use this information? Let's say you have two options. One bank is saying 10% with a quarterly compounding. The other investment is saying 10.25% annual compounding. Right? Probably just on a face of it, if I am looking at it, 10.25 looks attractive to me. Right? Another better example I'll give in the same context. Again, on one day I have seen an advertisement talking about banks typically when they are operating on gold loans, interest rates on gold loans kind of basis, a few years back. They used to operate it saying some percentage per annum is the interest rate. 12.5% per annum was the interest rate they were charging on gold loan. Whereas the gold loan company, it was specifying an interest rate of 1% per month. Their interest rate was 1% per month. The bank's interest rate was 12.5% per annum. Now, which one is charging a lesser interest rate? 1% per month, it does not translate into 12% per year. I may have to do it on either bring that also into a monthly compounding or take this into an annual compounding. So if I have to take this into annual compounding saying 1% per month. So I am talking about compounding for 12 months. So 1% per month is 1 plus 0.01, 1% to the power 12. 12.68%. Though they are saying 1% per month, on an annual basis it is working out to 12.68% per annum. Whereas the banks is working out only to 12.5% per annum. So sometimes this conversion to a particular time period is very much important for us. Right? So depending on how it is being quoted, we have to convert both of them into the same grounds to make the comparisons more and more better. So whenever we talk about the effective annual rate, you always look at it as the stated annual rate divided by the number of periods to the power again the number of periods, which will give you the effective annual rate for the period. So again, look into this example. Account that pays 7% compounded quarterly. So here it's compounded, the quarterly interest is not 7. Annual interest rate is 7. But the compounding is happening quarterly for a deposit of 5,000 or more that are left in the account for a period of 3 years. What is the effective annual rate in this case? What is the effective annual rate in this case? 7% divided by 4 to the power 4. This is your effective annual rate. So, based on that, you can compute on whatever the amount that is being asked. Again, you use a compounding for 3 years. But here we are asked only about the effective annual rate. So we are using only this is the rate 1 plus. So it will be more than 7% itself. And probably a better relationship, I'll tell you. So we'll talk about the same interest rate of 10%. Right? We'll take one example. Same interest rate of 10%. Let's say it is compounded yearly, semi-annual, quarterly, monthly, daily, right? And I'll use another word called continuous, which is minutely, secondly, hourly. That's a compounding. The derivatives world uses only the continuous compounding. Or probably even a stock market world also can use continuous compounding because the prices keep changing with a very split of moments, right? So the same 10%, if the quoted rate is the same 10%, but if I am looking at it, okay, on a yearly basis, it will be 10% only because 1 plus 10% by 1 to the power 1. So obviously this is becoming the same 10% itself. But if I do half yearly compounding, 1 plus 10% by 2 to the power 2, just subtracting 1. So 10.25%. Effective annual rate is 10.25. You are making it quarterly compounding. We have already seen that 10% by 4 to the power 4, which is 10.38%. Now, how long will it go like that? Then again, monthly, 1 plus 10% by 12 to the power 12, 10.47%. Daily, by 365 to the power 365. Daily is 10.51. So what is happening with the compounding frequency increasing? More times compounding is happening. Your effective rate is increasing. But it is increasing at a decreasing rate. Right? Here the gap is almost 0.25. But it has come down to 10.25, it became 10.38. Just another 0.13 addition. But here another 0.1 addition. But again 0.04 addition. So what is happening with the increase in the frequency? Obviously there is an increase in the effective annual rate, but it is at a very decreasing rate. Now again, even more minutely than daily, if we are doing, probably called as continuous compounding, probably hourly or minutely, secondly, instant kind of compounding. Probably it's like instead of 365, we take almost infinite. 1 plus 10% by infinite to the power infinite. Right? Mathematically, that works out. Probably if people remember the concept of limits, there is a usage there where it says, again, you don't need to remember that, limit when n tends to infinite, 1 plus some x by infinite, x by n to the power n is same as e power x. 1 plus x by n to the power n. Even in our case right now, 1 plus 10% by a very large value to the power large value. 1 plus n by 365 to the power 365. 1 plus 3000 to the power 3000. So this is the same format that is coming out. So because if this is becoming larger and larger, the denominator is becoming larger and larger, it actually boils down to something called e power x. So in this case, it becomes e power r, the stated rate, e power the stated rate. So that is what we call as continuous compounding. Continuous is at a very minute intervals. If I am doing the compounding, we are associating it to continuous compounding. And the way we find out the continuous compounding is e power. In our calculators, we see that e power is there. I'll show it to you. e power the stated rate, e power r. So almost you see the difference is very, very minute. From between daily compounding and continuous compounding, there is hardly much of a difference. You see that the differences are like this. 10.5156 is here, 10.5171 is here. So because daily is almost like continuous, right? Even more slightly lesser, the change is only by that amount of marginality. So which means whatever is the compounding you do, your effective return cannot be more than 10.5171%. When someone has quoted 10%, the highest possible return you may get is 10.5171%. That too if the compounding happens on a continuous basis. So a couple of things you need to understand from this exercise. If the frequency of compounding is increasing, you will definitely see that the effective annual rate will increase. So banks typically do it on a quarterly basis. So which means though they show 10% in the forms or in the displays or in that FD documents and all, what you get is not 10%, you will get more than 10%. Because the compounding is at a more frequent intervals of time on a quarterly basis, not on an annual basis. Probably you can check out any of your FDs with this kind of a concept. You will easily find out the difference. Right? So that's it on the effective annual rate. Now this is also we have discussed discrete versus continuous. You are increasing the frequency of compounding, effective annual rate is increasing, which we have seen. But that increases at a decreasing rate. And very, very short interval, minutely, secondly kind of compounding, we call it as continuous. And continuous compounding, you will directly go as e power the stated rate. E power the stated rate minus 1 will give you the interest rate. So that's what we have done here. E power 10% stated rate minus 1, giving us 10.51% as our stated rate. If sometimes the question could be the reverse. The question could be asked in the other way also. Let's say if the continuous compounded rate is 10.51%, what is the stated rate? Right? It may be asked in the reverse way also. So it's like okay, if someone is saying continuous compounded return e power I minus 1 is equal to, let's say, some 15%. Someone is saying continuous compounded rate of return is 15%, find the stated rate, the reverse calculation, right? So what is that you are doing? I have to find out I actually here. He has given e power I minus 1. So e power I is equal to 1 plus 15% or 1.15, and I comes out as logarithm of 1.15. That is where I have used this formula. If I have to go with a reverse calculation, I'll go as logarithm of, when the inverse of e power is nothing but logarithm. So log 1.15 when I do, I will get the reverse. Or probably for the above example itself, log 1 plus, when I do this, I should get 10%. Log 1 plus when I do this, I should get 10%. So it's a reverse. E power 10% minus 1 will give me 10.51. Log 1 plus 10.51 will give me 10%. That's the kind of a relationship. So depending on what is being given in the question, you have to plan it accordingly. So sometimes he may give a stated rate and ask you to find out continuous compounded rate. Or he may give a continuous compounded rate and he may ask you to find out the stated rate. You have to be comfortable with both the stuff. And generally, you will find that the returns are normally distributed. That is how we link our statistics with our finance terms, especially for stock markets kind of scenario. The returns, daily return, it generally follows a normal kind of a distribution. So again, you can link all the properties of the normal distribution, all those things, to your stock market return, right? Because it is very much assumed. You can test out any company's returns, probably last 1 year returns, daily returns you can take, and you can test out for the normal distributions on them. They will simply come out very close to normal. For some of them, they will be outrightly normal. Some of them may be very close to normal. And probably I can show that. Probably after the break, I'll download one of the company's returns and I'll show you they will be more or less normal itself. And so if the returns are normal, we find that the prices are log normal. We have discussed about the log normal distribution generally used for modeling the asset prices, because they cannot be negative in terms of the prices and quantities and all. So log normal is being used for modeling the prices. So that is where the stats and finance are getting linked. The returns, almost any stock market returns or any market returns, we see that they follow a normal distribution. So returns are following a normal distribution means they're continuous compounded returns. Which means when I do a e power or a log of that, it will follow a log normal kind of a distribution. That is where the prices, asset prices, will follow a log normal distribution. The logarithm of those prices, which is nothing but the returns, they follow a normal distribution. So that is where we are linking our statistical distributions with the financial concepts, right? Now, the next important or probably only important thing in our entire chapter on time value of money is few calculations using the calculator itself. There are 5 different words we have to be comfortable with in this whole chapter. One is called as present value, which is today's value. Today's value, in some questions it could be like, I'm depositing something today. Or in some questions it could be like, how much would I be getting, or how much should I deposit today? Right? Or in some questions it could be, what would be the worth of this investment as of today? So whenever we talk about the today's kind of stuff, we use the present value. We use a word called present value. Even in our calculator also, there is a button called a present value. In our calculator also, there is a button called present value, PV. The same way, we have another thing called FV, which is the future value. At a later point in time, let's say how much will I get after 5 years? Or I will get 1 lakh after 5 years. Where our future need not be 5 years, even tomorrow, or even tomorrow is also a future. As long as it is not today, any lump sum that we are receiving after today is what we put as a part of the future values, right? And the N, which is what, is the number of periods. It could be number of months, number of years, number of whatever it is. If someone is asking us to find out with respect to number of quarters, N is number of quarters. So though he says 5 years, but if I have to look at it from a quarterly standpoint, I'll take it as 20 quarters. Though the time period is 5 years, but if I have to look at from a quarter standpoint, I'll take N as 20. So that is 1. I by Y is nothing but the interest. To make things easier, take it as interest per period. So if your period is quarter, If he is saying compounded quarterly, if the question is somewhere using compounded quarterly, take the interest rate as quarterly rate. Though he has given a stated rate as 8%, you take the I as 2% and N in terms of number of quarters, not in number of years. That's the fourth component you have to be comfortable with. And the fifth is the PMT. For this PMT, the concept which we have to discuss here is annuity. Annuity is nothing but it's a series of equal payments at equal intervals of time. Let's say in our insurance premiums, we pay the same premium amount for some number of years at equal intervals of time. Rent on a building, same amount, equal intervals of time for some period. So it's not one-time payment or one-time receipt. It's a recurring payment. Wherever we have the scenarios of recurring payments at frequent intervals of time, recurring payments at equally spaced intervals of time, we use the concept of annuity. Recurring payment at frequent same intervals of time. Let's say let's say recurring deposit with the bank. Every month you do a same amount, probably with the same frequency every month, first of the month. So there are so many instances where we do the payments and receipts in that manner. Let's say our salary itself, right? It's like an annuity. Annuity, the concept is nothing but it's a recurring series of payments, equal value, equal intervals of time, at least for some period. That is what we are treating them as annuities. And within that annuities itself, we have the concept of ordinary or regular annuity versus annuity due. Regular annuity is nothing but that series of payments are at the end of the period. Let's say the EMI I pay on my loan. It's again equal payment, series of payments over some period. If I pay the payment at the end of each month, today if I take a loan, today I don't need to pay any interest, right? At the end of the month, I have to pay some interest, right? So if at all the payments are happening at the end of the period, we call those as regular annuities. And if the payments are happening at the beginning of the period, in advance itself, let's say the house rent, before I complete 1 month, before I enter itself, I have to make the first payment. Those kind of annuities are called as annuity due. Whereas if I am making the payment at the end of the period, I am associating it as regular annuity. And now when we look at the calculations, that PMT is what will take the values of the annuities. So in any numerical which we deal with, what we see is there will be 4 variables that would be given in the question. Out of these 5, 4 will be given. You have to compute the 5th one. So probably in this slide you are seeing some formulas and all those stuff. Not required when you are using the calculator. You should just enter those 4 values into the calculator and say compute the 5th value. It will give us the output. Right? Now, let's take a few numericals that will make things easier for us. Now, in this CPT button is nothing but compute. Compute something. Let's say the question is, let's take one example. In 5 years, What is the value of $200 invested today at an interest rate of 6% per year, compounded quarterly? So what are the numbers? What is this? This is our PV, because I am depositing something today. So this is the PV. This is, can I take this as N? We are saying compounded quarterly. So this into 4 will be my N, because I will convert it into number of quarters. So 20 will be my number of quarters. Then what would be the interest rate I? This is 6% per year. So 6% by 4, which is 1.5%, is per quarter. So now we have a PV value in our calculator. We have I. We have N. Right? What is PMT here? Is there any recurring payment in this? There is no recurring payment. It's a one-time payment and we are getting once. So there is no recurring payment anywhere. So PMT is 0 in this case. So 4 variables are there with me. What should I find out? FV. What is the value after 5 years? So I have to find out my FV. So in the calculator, all I have to do is, you click on those 4 numbers. You click 200. And yeah, in this one more thing is, if you are paying, if money is going out of your pocket, cash outflow, we will deposit it with a minus sign. Like you are depositing $200 today. It's going away from your pocket today. So you will write it as minus 200, not 200. Anything coming to us, we write it with a plus sign. This is a nomenclature we have to follow in the calculator. Anything we are paying, we'll put it with a minus. Anything we are receiving, we'll put it with a plus. Right? Now, so in this case, in this example, so probably once we discuss what are all these 4, we can, so PV in this example is minus 200. So I'll first type minus 200 and click on PV. Right? PV, then it becomes PV equal to minus 200. Then same logic. Then my I by Y is 1.5. You don't put percentage in the calculator, you just put it as 1.5. Then N is 20. PMT is 0. You enter these 4 elements. And finally you say compute FV. You say compute FV. You will get the future value at the end of that much period. So if I put the same calculation in a spreadsheet, what is that I am going to get? I'll say FV. So 1.5% is the interest rate, 20 periods, PMT is 0, PV is minus 200. So what it says is, if you are depositing 200 for a 5-year period at 6% per annum, compounded quarterly, you are going to receive 269.37 at the end of 5 years. Right? So you have to be comfortable only with respect to how do I convert each of them? How do I assign these calculator values to each of my values? So probably look at the second question and tell me what all can be assigned to each one of them. Okay, given a annual rate is 90, compounded monthly. Okay, I is 9% divided by 12. Okay, N is 36, 3 into 12. Compute the future value of 10,000 today. So PV is 10 or minus 10, minus 10,000. PMT is 0. And you say compute FP. The same question. So because it is a compounded monthly, so here you have to be comfortable that these three elements, N, I by Y and PMT, they should be in the same time period. In this example, of course, PMT is not there, so we don't need to bother about it. I as well as N, they should talk about the same period. If we are talking about compounding monthly, your I should be in per month and your N should be in terms of months. All of them should be, and if there is a PMT, recurring payment per month, all of them should be on a monthly basis itself. So if it is a quarter, all of them should be on the quarterly basis itself. Otherwise, you will get wrong calculation. Fine. This question is fine, right? You can just practice that out. And okay, another advice from a calculator standpoint, it's better that you reset the calculator every time. The reason being, the previous values, they can be stored until you reset. How do we do a reset? There is a button here. You see here, there is a reset here. Anything above the button, if there is any instruction above the button, you use the second button first. You click this second and then click that button. That is what, if I directly click the button, this would be operated. The plus and minus would be operated. But if you want the above one to be operated, because each button has two formulas in it. Every button, let's say you look at this button. If you directly press this, you will get the logarithm of a value. If you press that button after pressing second and that button, it will compute the e power x. So otherwise it's like if you just type 2 and press the button, it will give you the value of log 2. The same 2, if you press second and then the log button, you will get the value of e power 2. So anything on the above of the button, every button is having two formulas. Anything you are clicking on the above of the button, right? It should be executed using the second button. The one which is on the button itself, it should be executed directly by clicking on it. So here if I have to reset it, I have to click the second and the plus minus button, which will do the reset. All the older values will be erased. Otherwise what will happen is, let's say the previous question you have solved for some PMT. Just giving you an example. The previous question you have solved for a PMT and you have got some 20 as the PMT value. The next question, you are doing an FP calculation, let's say like this, where PMT is 0. Thinking that PMT is 0, you don't enter the value of PMT. Thinking that PMT is 0, you don't enter the value of PMT, you enter only the remaining 3 values. That old PMT of 20 is there in the system already. So the final FP which computes, it computes based on that PMT 20 itself. And if you forget omitting, probably you may directly write out the answer with that 20 being contained, because it will not erase off the old values until you do a reset. Or physically every time you remember that I have to enter PMT equal to 0. So, but rather than that, the better thing always is to reset. If you think that some values can overlap, it's better that you reset it itself rather than keeping it. Let's say you have entered the values for 10 years and done one calculation. The next example is the values are only for 5 years. So what you will do, you will enter the values for the 5 years and then compute something, because only 5 years are required. But earlier, because in the earlier question there were values up to 10, only these 5 years will be replaced with the new values which you are entering. But from 6 to 10, the older values will remain. And your calculation will come out based on that. So it's always better that you reset it before you do any calculation. It would be 2-3 more button clicks extra, but that will ensure some kind of foolproof into your calculation. Make sure, in the exam, these kind of tense moments don't come up. Right? All right. So now, let's take a couple of more questions. Yeah, look at the questions here. How much should an investor pay today for a 12-year annuity? Okay, we'll take regular annuity. 12-year regular annuity that will generate 800 per half year, given that he wants to earn 12% compounded half yearly. What are all the various numbers I can enter here? First of all, what is that I have to compute? He has to compute PV, because he has to find out how much should be invested today. How much has to be invested today is what has to be found out. Right? So this is a typical, think of it like a typical bond question. Right? How much you have to pay for acquiring a bond today, or a deposit which is saying we'll give you 800 every 6 months. A deposit is promising that they'll give you 800 for every 6 months for a 12-year period. Right? And let's say from an investor standpoint, he is expecting 12% return compounded semi-annually. So for me, I have to find out the PV. Correct? What is given? PMT is plus 800, because it will give me 800 every 6 months. So because it is 6 months, all my I and N and everything should be with respect to 6 months. My I is 6%, because 12% is per year, 6% is per 6 months, and N is 24. 12 years, I have to convert them into 6 months and use them. And FP, there is nothing, because at the end of 12 months, I am neither getting anything nor paying anything. It comes over a 12-month period, but not at the end of 12 months, 12 years. So what does it say now? If I take it into my spreadsheet, it says that PV, the rate is 6%, number of periods is 24, PMT is 800, and FB is 0. What this is saying, if I deposit 10,040 today, so probably it's like your retirement planning example. If you deposit 10,040 today, this deposit for the next 12 years, it can give you 800 per every half year. Assuming the interest rate is 12% per year compounded semi-annually, this investment of 10,000 which you will do today can fetch you 800 per 6 months over the next 12 years. That's the typical meaning of this. So if someone is, so the most of the investment decisions which we take will have to go using this kind of complex logic, including how much EMI should I pay on my loan. All these things can be executed using this kind of examples itself. So probably look at the next one. If 10,000 becomes 18,682 in 5 years, what is the investor's annual rate of return on a continuous compounded basis? Okay, for a continuous compounding, you can't use those 5 buttons. That 5 buttons don't work out for a continuous compounding example. E power is what works out for your continuous compounding kind of an example. Right? Okay, so what are we saying here? 10,000 is becoming 18,000 in 5 years. So the way I find out my return on a continuous compounding basis is 18,000, the final value, divided by the original value to the power 1 by 5. It's like a geometric mean. It's like a geometric mean on the data. So 18,000 divided by 10,000 to the power 1 by 5 is what is my continuously compounded rate of return. So minus 1 if I do. So if the question is about continuously compounded, so 18,682 divided by 10,000 to the power 1 by 5, which gives me some 13.31%. So my return is 13.31% per year if I am going it on a continuous compounded basis. So if the question is as long as the discrete compounding, quarterly compounding, daily compounding, all those kind of stuff, we can still use our PVFP kind of buttons. But if it is continuous compounding, we have to be slightly deviating in our calculations. Okay, the next one is again a typical example for us. 85,000 car loan is financed at 9% per year over 6 years. What is the EMI? So in this case, PV is 85,000. I am taking a loan of 85,000 today. So I am getting 85,000 today. The interest rate, because he is not talking of monthly, he is asking for a EMI. So monthly payment, PMT is on a monthly basis. So probably all the other things also should be in terms of months. So interest rate will be what? 9 by 12. N will be 6 into 12, which is 72. And FV is nothing. Because at the end of 6 years, we neither pay anything nor get anything, because everything is paid out within this EMI model itself. If the question is like, okay, you will pay something in the EMI form and some 20,000 you have to pay at the end of 6 years. Right? There is a lump sum payment of 20,000 at the end of 6 years. Then FV will become 20,000. So you have to plan out how the question is created, because today there is no traditional investment at all. All kinds of weird investments come into the market, where you will find all combinations in the investment. Probably you may not be even surprised if these kind of stuff come out. So every year, not even the EMI. Probably after 1 year, you do a down payment of this much. After 2 years, you do a down payment of this much. Then what is your EMI? These kind of weird things also typically come out as a part of the competition process, because no two companies can give the same type of advertisement. Right? I mean, not from an ambassador standpoint, but from a product standpoint, though the products are same by two companies, they cannot promote it in same manner. Probably if you observe the way the insurance companies do their promotion process, you will clearly see the difference. No one directly says you will get, let's say, 8% or something on the investment. They'll not talk about in the percentage return in a straightforward manner. You deposit with us, after 5 years you will get this much, after 10 years you will get this much, after 2 years you will get this much. This is the big story that is being typically given in most of the products. The reason being, unless the confusion is created in terms of what is the return, you cannot compare the two products. So every product is packaged in a unique manner. Right? So unless we are very clear on how do I apply these 4 things to compute, for me at the end, what is the annual return? Whichever is giving me more return, I will go for that, assuming they are all on the same risk plane. Whichever is giving me the slightly higher return, I'll go for it. Whatever is the complicated their product definition strategy is, whichever gives me the highest return, I'll typically opt for it. Right? That's the same thing we are bringing in here. So in this case, what does it work out to? Just trying out. Otherwise, you can plan out doing these similar kind of numericals. So I have to go for PMT. The interest rate is 9% by 12. The number of periods is 72. PV is 85,000. Then no FD. So I have to pay an EMI of 1,000 because it's a negative. I have to pay. Right? EMI is something that I have to pay. So that's where it is showing in negative. And it is saying I have to pay 1,532 every month for the next 72 months to pay off that loan. Right? So that is a typical way we have to solve. I think remaining things we'll just discuss what should be what. 5 equal annual deposits of 1,500 are made into an investment account, earning 8% starting today. When it is starting today, okay, keep that question on hold. We'll come to that once we do the remaining two. Yeah, look at the next one. If an investor puts 5,000 per year, starting at the end of the first year, in an account earning 9% and ends up accumulating 400,000, how many years did he take for the investor? We have PMT is 5,000 or minus 5,000. PMT is minus 5,000. FV is 400,000. I is 9 yearly interest rate. And you have to find out N, and PV is 0 because today you are not putting anything. PV is 0. 4 values are there with you. Compute N. In how many years? This 5,000 per year if you are depositing. In how many years that gets accumulated to 400,000, 4 lakhs. Number of years. So when I am going with 9% per year and 5,000 is being deposited every month, nothing is deposited lump sum. And let's say it becomes 400,000 after how many years? So this works out to 24.4 years. If you deposit your money for 24 years, see, because if there was no interest, probably you had to deposit 5,000 for 80 years. 80 into 5,000 is 400,000. Look at the power of compounding here. If you are depositing 5,000 every year, actually you have to deposit for 80 years to get accumulated to 4 lakhs. But because of compounding at 9% per year, if the 9% interest rate is provided to you per year, the same 5,000 you are putting in will become 4 lakhs in 24 years itself. So you are saving almost 56 years just because of compounding. Right? So probably you cannot ignore the interest factor at all. Right? Probably the best examples are you always keep hearing these kind of things. Double your money in 6 years, double your money in 7 years kind of typical ad. And if you directly convert them into interest rates, it is hardly the same 9% or 10%. So which means you put your money in an FD also for 6-7 years. Without any risk, you can double your money. Right? So I mean, the way it is packaged is different. In packaging, they'll never say we'll give you 9% interest or 10% interest because even a bank is giving the same. But if I say double your money in 2 years, in 5 years or in 7 years, the mindset in the people is, oh, they are giving some 14-15% interest. But if you work it out, it is nothing but 9-10% interest only. Because of the compounding, you are finding that the interest rate is only that much. Right? So like this example itself. And what about the next? If an investment earns 200 forever, whenever we are talking of forever kind of investment, not just 20 years, 25 years kind of stuff, but forever, typically like the dividends on an equity investment. As long as your investment in the company continues, there is no end to it. Next 10 generations of yours also can continue the investment as long as that company exists and you exist, your generations exist. Right? So if that is the kind of investment we are talking of, there the payments are forever kind of stuff. Right? So whenever we are talking about an annuity, not for some amount of period but forever kind of stuff, we call those kind of annuities as perpetuities. As perpetuities. Those kind of annuities are specific annuities called perpetuity where the payments or receipts happen for lifetime. No years are defined for that. It's forever kind of stuff. Especially the dividend payments on an equity stock, you can associate it as a kind of perpetuity, or probably to some extent even the pension payments also can be treated as perpetuity as long as the person exists. But of course, again, probably you can think of how many years he may be alive, and you can convert it from a perpetuity to some kind of an annuity. But in a realistic sense, if the number of periods is infinitely large, then we can directly call it as a perpetuity. And in case of perpetuity, if I want PV, even then I cannot apply that 5. Just like continuous compounding, I cannot apply those 5. Even for a PV also, I cannot apply the 5. The simple formula which I am applying is PMT by I, which is how much I am getting every period divided by interest per period. And there is no FV for a perpetuity because I don't know what is the future date. No future date is known, so no future value. Only PV can be computed for a perpetuity. And the way it can be computed is that equal annual installment or equal monthly installment divided by monthly interest. Equal annual installment divided by annual interest. Just like this numerical here. If an investment earns 200 forever and the interest rate is 8%, probably per month or per year, whatever it is. Right? If the investment is earning 200 forever per year and the interest rate is 8% per year. So the how much needs to be invested today? 200 by 8%. 1000, 1250. 2000, 2500. 2500 is what you have to invest today, and it will pay you 8% per the 8% is 200 per year forever. So if some stock says will pay you 200 forever and your return is 8%, right? Today there are some bonds which have come into the market. They are called as perpetuity bonds, right? So probably you should, I think, if I'm not wrong, Tata Power has come out with a perpetuity bond, right? Of course, they have given options of if you want to exit at any point 10 years, after 10 years or after 15 years, you can exit. But otherwise, it's a perpetuity bond. So if I have to value that kind of a perpetuity bond, how much should be invested into that perpetuity bond? What is that they are giving on an annual basis divided by the annual interest if I'm doing? Forever I will get that money. Which means if I invest 2,500 today, forever 200 will be allocated. Probably another better example is typically in temples kind of stuff, they ask you make a one-time payment, and on your name every day or every year on a particular day something will be allotted. So that's also like a perpetuity. Forever some particular amount will be taken and being allotted from your pool amount. So which is like you have deposited a lump sum, but every year there is some constant payment. It's not for a particular number of years. It's for a longer period. It's forever kind of stuff. That's the way they typically talk about it. It's forever kind of stuff. So those are all going as a part of perpetuity, the annuity with an infinitely large kind of a life. And okay, one more thing is annuity due. If the annuity due example is there, like this one, 5 equal annual deposits of 1500 are made into an investment account earning 8% starting today. So if the first payment happens at the end of the period, if the annuity is the first payment happens at the end of the period, we call them as regular annuities, and in the calculator we do it the regular way itself. But wherever we see that it is not a regular annuity but it is an annuity due, we do some kind of small modifications on our calculator. Before we do the whole calculation process, we set the calculator in what is called as a begin mode. By default, it will be in the end mode. You will see a small icon at the top here. It is not showing. Sorry. It will show somewhere here. It will show something called end. But which means it is by default applicable for a regular annuity kind of a process. But if you set it to begin by clicking here, how do I click the begin part? Second and then this button. If I do it, it will be set into a begin mode. You will see BGN at the top there. So the calculator is set into the begin mode. Only applicable if you are solving the annuity due kind of examples. If there is a regular annuity kind of stuff, you don't need to bother about it. But if the questions have annuity due kind of thing, you have to be slightly careful about that. You have to set your calculator into the begin mode and you can solve for it. Otherwise, I have another, probably if you are comfortable only, you listen to it. Let's say if I am saying I am paying 10,000, 5,000 per year for 5 years, at the beginning of the year. What is the value at the end of 5 years? Or what is the value after my investments are over? What is the value after all the investments are over? Or probably at the end of 5 years. So here it is what, today I am making the 1,000. After one more year, another 1,000, which is at the beginning of the second year, one more 1,000 is made. The beginning of the third year, one more 1,000, fourth year, fifth year. Rather than that, what I can think of is, the first year one, take it aside. Whatever you are paying today. From the second year, beginning of the second year is same as ending of the first year. You can very well visualize the beginning of the second year as the ending of the first year. Beginning of the third year as the ending of the second year. So how do I look at beginning of second, third, fourth and fifth years? I can take it as ending of 1, 2, 3, 4 years. I can do that. So what is that I can do now? The first payment which I am doing, I will take it as PV because I am depositing it today. I will take it as PV. PMT, which is the payment which I am making at the end of each of the periods. The beginning of the next period onwards is end of each of the period. So I will take this as minus 1,000. I am doing a payment for 4 years. End of first year, end of second year, end of third year, end of fourth year. I'm doing the payment for 4 years. So all I can do is I can find out, and whatever is the interest rate, I can find out the FV. But this FV gives me the FV at the end of 4 years. FV at the end of 4 years is what it will give me. From there you take it for 1 more year. You multiply it by the interest rate again, you will get it at the end of 5 years. If you can make, which one making it into begin mode? That is, if you forget the begin mode, if you are able to set your calculator into the begin mode, it is straightforward. Any question containing the annuity due kind of a calculation, you immediately make sure that your calculator is set into a begin mode and the calculation is done. Rest all, the entries are the same. FV, PV, all entries remain the same. Only the thing is calculator should be set into the begin mode. In the regular case, wherever the payment is happening at the end of the year, you can set it into the end mode itself. Now, some slightly complex calculations. Sometimes they involve two different kinds of calculations within one single. Just look at these things. Slightly different kind of examples. An investor will receive 5,000 a year for 7 years. The first payment will be received 5 years from today, not today. He is receiving it 5 years from today. If the annual rate of interest is 11.5%, what is the present value of this? Present value means I want today's value. So in these kind of questions, better you draw a timeline. Better draw a timeline. So what is that we are saying? So still you can use your formulas, but you have to be clear in the timelines. Okay, you are getting 5,000 a year for 7 years. Fine. The first payment is to be received 5 years from today. If today is 0 years, 1 year from today, 2 years from today, 3 years, 4 years, 5 years. So there is 5 years from today, which is here. Here you are receiving after 5 years from now. That is 5 years from today. So after 5 years, you are receiving how much? The first 5,000 is what you are receiving. And from there, for 7 years you are receiving 5, after 6 years, after 7, after 8, after 9, after 10, after 11. These are the 7 equal payments which you are receiving of 5,000 each. Okay. The first payment is to be received 5 years from today. Annual interest rate is 11.5%. Fine. What is the present value of this annuity? Now, what all numbers I can put? First, you can do for this portion. First, you do shifting yourself to that date. You shift yourself to this position. Then you can apply a formula. Every year, 5,000 is paid. So, PMT is 5,000 you are receiving. So, it's a plus 5,000. Are you receiving at the beginning of the period or at the end of the period? When you shift yourself to 5,000, 5th year. When you shift yourself here, 5 years from now, you are getting your first payment on that day itself, right? So it's at the beginning of the period. Let's say you are moving, you are moving because you are getting your first payment. You are getting your first payment 5 years from now. So in the timeline, let's say you have shifted to 5 years. After 5 years, right? When you are shifting to after 5 years, the first payment is coming on that day itself. The first payment is coming on that day. The second payment after 1 more year. Like that you are getting your 7 payment. So you may have to shift yourself to begin mode. PMT is 5,000. Interest rate is 11.5%. N is 7. And you calculate the PV. Clear until that? Or I'll give you one more option. Shift yourself only to 4 years from now. Don't shift to 5 years from now. Shift yourself only to 4 years ahead. The 5,000 which you are going to get is 1 year from now, at the end of the year. If your positioning is at 5 years from now, you are getting it on that day itself. But if your positioning is 4 years from now, you are getting it at the end of 1 year, at the end of 2, at the end of 3, like that at the end of 7 years. So then it is a regular annuity. So the same question, you can handle it in both the ways. I'll show both the ways. Both the answers should come to be the same for us. Right? Okay. So, okay, I'll go with your case. At the end of 5 years, I'm shifting. It is an annuity due. So, I have to shift my calculator into the begin mode and then do the solving. Right? So, I'll put it in a spreadsheet to show the difference between the two. Okay, so I'm finding out the PV. Right? Using the interest rate is 11.5%. Number of periods is 7. PMT is 5,000. And FV is 0. And this is in the begin mode. Okay, Excel has the begin mode separately. So here this is 25,000. So the PV is 25,851. If I go like shift myself to the 4 years period, not 5 years period. So in that case, my PV will be, rate is still 11.5%. My number of periods is still 7. PMT is 5,000. FV is 0. So this is some 23,000. Keep them aside. So, which means my value as on this date, the present value is nothing but the value today. But because we have shifted there, today is that day. As of that day, the value is 25,851. And I have shifted only up to here. In the second example, I have shifted only up to here, 4 years from now. So as on that day, the value is 23,185. But the question is not about those intermediate days. The question is all about find out the value as of today. This is the today for the question. Just for our comfort, we have shifted ourselves to those days. So which means now this value, whatever we got, will become our future value. Now I am shifting from there to 0. So that value which is after 5 years will be the future value. Time period is 5 years. Interest rate is 11.5%. I can find out the PV. So the FV probably will be again the negative of this. Right? Because now that is like an amount which I would be getting. So now what is that? I'll find the PV with 11.5% interest, 5 years period as per your example. PMT is not there now because during this 5-year period nothing is being paid, only lump sum. And FV is working out to this number. So it says the current value is 15,000. So it's like if you deposit 15,000 today, after 5 years you can get 5,000 for a 7-year period. If the interest rate prevailing is 11.5%, you deposit 15,000 today, lump sum, one-time payment, you will get 5,000 per year for 7 years with the first payment starting 5 years from today. Even in the second case also I should get the same answer. I'll take the minus of this. So here I will discount only for 4 years because I have shifted only to 4 years from now. So 11.5%, 4 years, PMT is 0, my FV is this much. So whether I do it as regular annuity or as an annuity due, there will not be any difference in my calculations. Provided I understand the question correctly and shift myself accordingly. If I have to do it as regular annuity, it is sufficient that I shift only 4 years. Because the first payment should come at the end of the period. But if I am looking at it as an annuity due kind of a question, I have to shift myself for 5 years because the first payment should come on that day itself. So your calculator settings, you should not get confused between these two models. Any one of them you are using, you should be more confident in the usage of that particular model itself. Fine. Okay, let's try out one more example. Okay, perpetuity anyhow we have done. Even the perpetuity also slightly different. Just tell me how we do it. Compute the present value of the perpetuity, 100 payment, 100 beginning 4 years from now. So the payment is not coming today. The first 100 is not coming today. Appropriate annual interest rate is 10%. The first payment is to be received 5 years from today. 5 years from today. It is end of the 5th year itself, right? 1 year from today is after 1 year. 2 years from today is after 2 years. So there directly it is given, it's the end of the 5th year itself. You are having something? 5 years from today, when see, make it simple. No? If I say 1 year from today, what does that mean? At the end of 1 year. So 5 years from today as an English usage when I am using, it's at the end of 5 years. It's not in the 5th year at what time. That gap between today and when I am getting it is full 5 years. 5 into 365 days. Right? Otherwise he'll say probably in the 5th year or those kind of words will be used. When I am using 5 years from today, that the gap between today and the future date is exactly 5 years. So whatever is the date, from today 5 full years. So it is end of the 5th year for me. When I say 1 year from today, it's not the beginning of the first year, it's the end of 1 year. Right? Otherwise we won't say 1 year from today. Because even today is a part of the 1 year. But today is the beginning of 1 year. 1 year from today means end of the first year almost. Right? So in this case, perpetuity also we do the same. Though the calculation is PV is 100 by 10%, which is 1000. But this 1000 is not the PV as of today. In the timeline, after 4 years. So this is 1000. So again you take this as FV, 4 years as N, compute the PV, which is what will give you slightly lesser than that. Okay. This is an interesting question. The next two are pretty interesting one. A person borrows 20,000 to be paid back in 4 equal annual installments at an interest rate of 8%. Find the interest and the principal of the second installment. Amortization is the mechanism that I have to use. So first of all, I need to find out what is the PMT. How do I find out the PMT? So basically 20,000 is the PV. This is the I, this is the N. So I can find out PMT. Okay. So my PMT is, the rate is 8%, 4 periods. I'm taking a 20,000 loan and no FE. So PMT is coming out to 6,038. Every period I have to pay 6,038. So I am borrowing 20,000 with the interest. I have to pay 6,038 every month, every year for 4 years. Now the question is, out of this 6,038, how much is the interest? How much is the principal? Out of this, I am paying 6,038. But out of this, how much is the portion of interest? How much is the portion of the principal? In the first year. After that, I can look at the second year. There are multiple ways of doing it. But for a second year, it's always better to go one by one. First year and then the second year. That's more easier than a straightforward approach. I'll talk about that other approach also. Now, if it is 6,038 per year, what is the interest in the first year? 8% on your principal is actually the interest. On 20,000, 8% is the interest part. So how much is the interest part? 20,000 into 8%. So 1,600 is the interest part. So but you are still paying 6,038, which means the remaining amount which you are paying is the payment towards the principal. So apart from interest in the first year, you are even paying some portion of the principal also. So how much is your principal payment here? Whatever is the negative of this, minus 1,600. So you are paying 4,400 as the principal. So at the end of 1 year, your principal is only 20,000 minus this, because though you have taken 20,000 loan, apart from the interest, you have also paid some portion of the principal, because the equal installment or EMI kind of a mechanism is taking into consideration some portion of the principal repayment also, apart from the interest payment. So at the end of 1 year, your principal that is left is 15,561 only. So if the question is find the interest and the principal for the first installment, you will say the interest is 1,600, principal is 4,400. Out of whatever the EMI you are paying or EYI you are paying, the interest component is 1,600, the principal component is 4,400. But the question is about second installment. So in the second installment, what are we saying is the interest part is 8% on what is the principal that is left only. On this principal, the 8% is your interest. This is the interest part. But what is the principal? You are still paying 6,000 only. You are still paying an EMI of 6,000 every year. So which means your principal part is the whatever is left after this. So you are paying around 4,700 towards the principal. So what is happening now to your final principal at the end of 2 years? Your outstanding principal is only 10,768 now. The same logic you apply to the third year. The interest will be 8% on this. Correct? Interest will be 8% on this, which is 861. Whereas now, but you are still paying 6,038. So the remaining amount will go towards your principal repayment. So your outstanding principal now will be to the extent of 5,591. The same logic again, your interest portion will be 8% of this, whereas you are still paying 6,038. So your principal repayment is this much. So your outstanding at the end of 4 years is going to be 0. That is what will say your loan is getting completely paid off. Including your principal, your loan got completely paid off because you have repaid the principal amount over the 4 years itself. That is what is the concept of EMI. You don't pay only the interest. You are paying interest and some portion of the principal in such and the value of 6038 is computed in that manner. One period, right? See, for every period we don't need to take a compounding there because we are taking the interest for every period. So let's say for 1600, right? Here my assumption is I'm paying every year. If the question is every month, then the compounding will happen every month. So I'll make a monthly sheet, not a yearly sheet. I don't have only 4 rows here. I'll have 48 rows there. Right? So what is the monthly interest? So that is the interest portion. The remaining is the principal portion. At the end of 1 month, this is my outstanding principal. Again on that, probably 1% is the interest. Remaining is the principal. Again the principal will be reduced. Like that, if you do at the end of 48 months, your principal should be 0. That is what is your EMI mode of calculation. So because we are doing it for one period at a time, there is no difference between a compound and a simple. Only if I have multiple periods, we have an issue of simple and compound. Here it's the one and the same. Right? So in this question, the question is more about what is the interest and principal of the second installment. So probably I can very well say this is my interest part, this is my principal part of the second installment. Sometimes he may ask a question. I mean, again, these are very rare questions, or probably that level cannot go also. Without computing, if I want to find out what is the component of my interest, let's say if the question is given, I am doing a 20-year period, and what is the interest component of the 10th year? Which generally those kind of questions are never asked for us. But otherwise, also if they are asked, I don't need to make a 11-year schedule for that. You find out, now you know what is the PMT value. You know the PMT value, you know the interest rate, you know the number of years. Let's say I want for the 11th year, you find the PV for 10 years, you find the PV for 11 years. You find the PV for 10 years using PMT, which is 6038, whatever is the number that you get. Now that PMT value is known. So you have a PMT value known. You have N equal to 10 years. You have I. Interest rate is known. With these 3, FP is 0 only. Use these 4, you will find out the PV. So the PV at the end of 10 years is this much. Same way you will say PV at the end of 11 years. Right? You can find out the PV at the end of 10 years, PV at the end of 11 years. The difference between the two is the principal which you have repaid between the 10 year and 11 years. PV at the end of 10 years, PV at the end of 11 years. The difference between the two is what is the principal that you have repaid between 10th and the 11th year. You know the total money paid between 10th and 11th year is nothing but this into 12. If it is monthly installment, this into 12 is the total amount which you have paid within that period. This is the principal amount which is paid within that period. Subtract these two, it will tell you the interest amount that you have paid within the period. If at all the questions are more, that kind of complicated questions typically are not there. But even in a practical world, if you have to find out, you can use those kind of logics. You can use 2 different periods, PVs using the other amounts. Right? If I say PV at the end of the 10th year, you still have to make 10 more years. The number is after the PMT is done, you have this word called amortization. You have this amortization. So you click on that second and amortization. It will give you the first period, the second period. It will typically show the number. It will ask which period. Let's say you have made a 4-year here. You just say 2. It will give you the second period, the principal. That's where if I just say 2, the first starting period being 2 and the ending period being 2, it will give only my second period principal as well as my interest. But if I see in most of the questions, what he asks is for some period, what is the principal payment or what is the interest payment. Either I make an amortization schedule kind of stuff like this, or I can directly go to the amortization thing in the calculator and specify the period. So generally it will be for, he will ask for any one period. So in the input, you give, let's say, from 2 to 2 or 3 to 3, which means only for that third period, it will give you what is the principal and what is the interest portion of it. Right? And then, yeah, this is one more interesting question before we wind up this chapter. It will cost 20,000 a year for 4 years. When an 8-year-old child is ready for college, how much should be invested today if the child will make the first of the 4 annual withdrawals 10 years from today? So timeline if I am making, for the first 10 years, no withdrawal. So today we are here. At the end of 10 years, the first withdrawal of 20,000 is being made for a 4-year period. Right? It will cost 20,000 a year for 4 years. So when an 80-year-old child is ready for college, that's an extra information, no use. How much should be invested today if the child were to make a first of the 4 annual withdrawals 10 years from today? So here is the first 20,000 which is withdrawn. Then the next 20,000 is here and so on. So probably you are first shifting here. PMT is minus 20,000 or PMT is 20,000. N is 4. Annuity due. And the interest rate is 8. You will find out the PV. Then whatever that PV is at the end of 10 years, you convert that as the FV. So it's like you are breaking one problem into 2 problems. In all these 3-4 questions, you are breaking that one problem into 2 problems, or in some cases you may have to break them into multiple problems. That is what the real world scenarios will always be in a multiple breakdown kind of stuff. So that's where he has introduced you just to understand how, if the multiple payment kind of scenarios are there, how do you typically handle them. That is what is the intention of these small questions. But in reality, you will find even more complicated in these kind of stuff. It just need not be one payment or one breakdown or 2 breakdowns. It may be multiple also. But at the end, you have to be step by step in terms of evaluating. So I find the PV at the end of 10 years, make that as the FV, and again take the PV for now. In some questions, what could also happen is the interest rates will be different for each of the periods. So you have to be very careful in applying the. So he'll say for the first 10 years, the interest rates are 9%, but from 10 to 15 years, the interest rates are 8%. So when you are doing a PV for the second part, you will apply 8%. When you are doing a PV for the first part, after you make that as FV, you will apply the 9%. So you have to be very careful and drawing a timeline. And the biggest mistake which happens and for which you will have answers also is, should I shift 10 periods or 9 periods? And should I set it to annuity due or regular annuity? And most of the times I'll see the answers which contain all these situations, right? So picking up the correct answer. So even if you make it wrong, you will find an answer there in the option choices. You will definitely find that answer because those are the trapping points. So he'll make sure that by taking n equal to 9 as well as n equal to 10, both the answers will be there. So unless you are careful about the concept, it does not become easier for you to solve that kind of a question. All right. So this kind of examples, you will use them. Probably getting comfortable with that five buttons, usage of those five buttons will help you in solving too many questions in our other chapters also at a later point, whether it is our bond calculations or derivative calculations. In all these cases, equity calculations, in all these cases will apply the same concepts again and again, right? So just getting a comfort level, usage of calculator. So probably one day when you get your calculator, we can rework on those kind of concepts, right? Probably you can start practicing through this, and if you are stuck, we can again work out on them. All right.